This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Up in the air, Fidel Castro is gone, and the American president-elect wants a better deal between the U.S. and Cuba. What's next in the evolving and fragile economic relationship between the two countries?
Buy low, sell high. After a massive market run-up, are retail investors buying stocks at the wrong time?
And guessing game. Can OPEC members set aside their differences and cut oil output for the first time since 2008? Those stories and more tonight on Nightly Business Report for Monday, November 28th.
Good evening, everyone, and welcome. New doubt is being cast this evening on America's economic relationship with Cuba following the death this weekend of revolutionary leader Fidel Castro. This morning, President-elect Donald Trump threatened to roll back recently restored relations with the island nation. In a tweet, he wrote, "If Cuba is unwilling to make a better deal for the Cuban people, the Cuban American people, and the U.S. as a whole, I will terminate deal." The tweet came the same day commercial flights to the island nation resumed. American Airlines took off from Miami. JetBlue departed from New York. Michelle Caruso-Cabrera reports tonight from Havana.
Although Fidel Castro stopped ruling Cuba 10 years ago, his presence loomed large until the end. Observers have long speculated that his successor, younger brother Raul, might make more meaningful economic changes once Fidel was gone.
But the economic reform program that Raul began in 2011, which is to move toward more of a market socialism on the China model, was something that Fidel Castro had always rejected himself. And the normalization of U.S.-Cuban relations is something that Fidel Castro was very skeptical about. Right after Obama's visit to Havana in March, he said that Cuba didn't need anything from the United States.
It's the third official day of mourning for Fidel Castro here in Cuba, and thousands of Cubans have lined up here at the Plaza of the Revolution so they can go see his ashes and sign a book of condolences.
Nothing is going to change. We continue the legacy from Fidel Castro.
We all want change. Life is about changing, so that's it.
Notice no one in line is staring at their phone, texting, tweeting, or posting on Facebook. That's because internet service is almost non-existent in Cuba, part of the legacy of nearly 60 years of communist rule that severely restricted both political and economic freedom. Not to mention an economic embargo imposed by the United States government dating back to the 60s. But the thawing of relations between the United States and Cuba, initiated in December of 2014, has meant thousands more U.S. visitors to the isolated island. Loosening of regulations means it's easier to visit. And just this week, many U.S. airlines began direct flights to Havana.
What remains unclear is whether or not those changes are rolled back by President-elect Donald Trump once he takes office. For Nightly Business Report, Michelle Caruso-Cabrera, Havana, Cuba.
And now for more on what U.S.-Cuba economic relations might look like, John Harwood joins us from outside Trump Tower. John, good evening. Elaborate on what the president-elect's position is and what he may do and what he can't do when he takes office.
Well, first of all, he put out over the weekend a very strong statement criticizing the crimes and repression of Fidel Castro. But he also said, Tyler, that he wants to help the Cuban people on their journey to prosperity and security. That suggests that, as in his tweet today, when he said he wants a better deal for Cubans and for the United States, that he is open to trying to make a deal that sustains what President Obama has done so far and builds upon it.
So what did the White House have to say about it all today?
Well, the White House noted that even though executive action is all that's taken place, remember, there's an embargo that is legally in place that Congress needs to overturn if they decide to do that. But the White House said that it's not so easy. Airlines have made plans based on the change that's taken place. Hotels, the hospitality industry has made plans based on those changes. People in the United States and in Cuba have become accustomed to some of the new regulations about travel and sending remittances back and forth, that sort of thing. So it's difficult to immediately uproot changes that have begun to seep through all corners of American society and the economy.
Moving at the same time, John, is the decision apparently on who might be the Secretary of State. It sounds like the choice has divided the Trump team. What do we know about the search?
Well, we know that Kellyanne Conway, the former Trump campaign manager, trashed Mitt Romney over the weekend in very stark terms. We know that David Petraeus, the former general, who of course has been on probation for leaking classified or giving classified information to his then mistress, was at Trump Tower today, we believe, interviewing for the Secretary of State's job. Rudy Giuliani has been a front runner, and Bob Corker, the chairman of the Senate Foreign Relations Committee, is coming tomorrow, and Mitt Romney's coming for a second interview. This is a jump ball. It's wide open right now.
All right, John Harwood, thanks very much. John Harwood in New York City.
On Wall Street, the Trump rally took a breather as the financial sector weighed on the broader market. Even the small-cap Russell 2000 index fell back after rising for 15 straight sessions. The Dow Jones Industrial Average closed lower by 54 points to 19,097. The Nasdaq fell 30. The S&P 500 was off 11. Despite today's pullback, though, there has been a massive run-up since the election. But are retail investors getting bullish and buying stocks at the wrong time? Bob Pisani takes a look.
If you're a little skeptical about the markets hitting historic highs twice last week, you should be. The market's on a little bit of thin ice right now. Now, here's why. First, investor sentiment has gone from skeptical to extremely bullish. That's not a good sign, particularly when you see it happening among retail investors. At the end of last week, a survey of retail investors spiked to almost 50% bullish, from 23% bullish just the week before the election. It was the highest reading in nearly 2 years. Now, big spikes in retail investor sentiment have traditionally been associated with at least a short-term top in the market. Second, going long stocks and short bonds, it's a lot less attractive now than it was a month ago. The trade's been made. The small cap Russell 2000 is up 13% in 3 weeks. And bond prices, the 10-year yield, down about 3%. The retail investor seems to be excited right at the market top. Finally, the rally is pricing in a near perfect environment, but there's a lot of things that could go wrong. So a strong dollar could be a big problem for multinationals who export, as well as for emerging markets like China. Second, any move to aggressively translate Trump's trade war rhetoric into reality will be a big problem. Third, lengthy delays are likely in enacting any stimulus or infrastructure plan, tax cuts, and reductions in regulations. All three of these, for the most part, late 2017 and 2018 events. Finally, the biggest problem could happen if the Fed starts sounding like it may raise rates more aggressively than expected. The markets definitely have not priced that one in. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Gabriela Santos joins us now to talk more about the market and the potential risks she sees that could derail this rally. She's global market strategist at J.P. Morgan Funds. Gabriela, welcome as always. Great to see you. You just heard Bob Pisani characterize this market as being on thin ice. He also said that retail investors are increasingly bullish. Do you see this as a market on thin ice? And what do you make of the sentiment of retail investors?
We do not, and I think we have to keep in mind two things. The first thing is the fact that fundamentals are actually already positive for U.S. equities before the election. So there's been an acceleration in sentiment and in performance after the election, but this has already been on a foundation that was quite positive. Growth was picking up, earnings were turning positive again, and the global economy was healing. So it's already a positive backdrop. And when it comes to the second part, when it comes to retail investors, our conversations with our long-term clients is still one where there's still tremendous amount of cash on the sidelines, over $12 trillion. So it's still a situation where a lot of retail investors are very underweight equities or underweight investments in general.
What are the warning signs that you are keeping an eye on or possible problems that the market may encounter? The Fed, Bob mentioned the Fed may be getting a little bit too aggressive as one of them, but what else is on your radar?
Well, there's short-term risks, right? Part of investing in U.S. equities comes with some normal pullbacks, a normal amount of volatility. And these could arise around central bank meetings. They could arise around political concerns in Europe. That's possible. But if we think about the medium to long-term outlook, it has to be about a change in fundamentals, right? And as we mentioned, they were looking positive even going into the election. So what we keep an eye out on are variables that could change this course in the medium term. So things like wage pressure, U.S. dollar strength, U.S. policy over the next few years. Those are the long-term themes that could shape our long-term view of U.S. equities.
Let's take a sort of closer view at some of the sectors you like. I know that you and J.P. Morgan were early to say that financials would do well, and indeed they have. Do you still feel that they're a good place to put money, number one? And number two, what other sectors do you like?
We do, and this is part of a broader theme of cyclicals over defensives. So if we think about the market hovering around all-time highs, and it had a nice run in the second half of the year, but there was a lot of dynamics going on beneath the surface. The whole first half of the year was about some very defensive sectors that are used purely for yield and as a safe haven, let's say, in the case of a U.S. recession, which was a concern a few months ago. Now the picture is very different. It is one where economic and earnings growth is picking up. So as a whole, we would be looking at cyclical sectors, financials being one of them.
All right, Gabriela, thank you very much. As always, Gabriela Santos with J.P. Morgan Funds.
The meeting of oil producers is just 2 days away, and crude prices have been whipsawed. Today, the commodity rose more than 2% after tumbling about 3% on Friday. And as Jackie DeAngelis reports, it's all because of some very big question marks surrounding the OPEC meeting on Wednesday.
When OPEC said it would cut production in late September, but announced final details at its November 30th meeting, everyone wondered why. Now, as that meeting approaches, it's becoming increasingly clear. Some members of the cartel, like the Saudis, want the cut. Others, like Iraq and Iran, are still holding out 2 days before the meeting, and it seems there still may be no consensus. And to further complicate matters, speculation is building that OPEC may be pressuring Russia to cut output as well, so it's not alone in its bold move. But the Russians need the revenue and may not be eager to play ball. All the volatility has raised crude prices over $45 a barrel, but all the doubts have kept them under $50.
They're closer to agreement than disagreement right now. I think they've tempered some of their rhetoric, and I think there's a chance of some sort of a accord of sorts. I wouldn't say it's a full-fledged, lock-solid kind of a, line in the sand, but I think there may be some sort of talk about at least moderating production.
Over the weekend, a surprising comment from the Saudi energy minister saying that the markets will rebalance with or without a cut, possibly setting the stage to take no action. In late September, OPEC said it would cut 750,000 barrels per day from its production. The market now hoping that it would see a steeper cut than that.
If there's no deal, I don't see the catastrophic drop-off that people are predicting. I think this market could back off a bit and certainly trade, let's say, to the mid-40s. But I don't think this market's going much lower. It seems to have built a pretty strong base here. I'm leaning more to the fact that we probably can work our way higher.
With the dollar strengthening and the OPEC deal hanging by a thread, crude prices just might see that three handle again. For Nightly Business Report, I'm Jackie DeAngelis.
And still ahead, why some say the most beaten down sectors could deliver the biggest comeback and the best return among stocks.
A blow to Boeing. The World Trade Organization said that Washington state offered billions of dollars in illegal tax breaks to the plane maker. The key tax benefits came on the condition that Boeing keep production of its newest long-haul jetliner in that state. The ruling is part of a long-standing battle between Boeing and its European rival, Airbus.
Well, Time reportedly says no to a takeover bid from a billionaire investor, and that is where we begin tonight's market focus. Multiple reports say Edgar Bronfman Jr., along with two other executives, approached the publisher of People and Sports Illustrated with a deal worth $18 a share. That values Time at just under $2 billion, but the company rejected that offer. Time Inc. shares soared following the news, up more than 17% on the session to $16 even. The activist investment fund Elliott Management sent a letter to Cognizant Technology urging the IT services provider to make changes it said could lift Cognizant's share price above $90 by the end of next year. Elliott Management, which owns more than 4% of Cognizant, outlined plans for improvements which include job cuts. Cognizant rose just about 7% today to finish at 56.95. And BTIG slapped H&R Block with a sell rating on concerns that potential changes to the tax filing process under a Trump administration could cut into the demand for the tax preparation company's services. BTIG also cut its price target on the stock to $18 a share, and shares plunged today by 9% to $21.82.
Schlumberger said it signed a preliminary agreement with Iran to study oil fields in that country. The deal gives the world's largest oil field services company access to 3 fields, but doesn't include any services operations. Schlumberger shares were off a fraction to $81.06. And United Health gave an upbeat forecast for 2017, forecasting earnings and revenue to come in above analysts' expectations. That news sent shares initially higher in after-hours trading. They finished the regular session down just a fraction to 152.11.
Well, there is a school of thought that the best stocks or sectors to buy are those that have fallen dramatically. It's a high-risk strategy, but one that could bring big rewards for those with a strong stomach. Mike Santoli runs through some of the deeply discounted groups.
2016 has turned out pretty nicely for Wall Street, with the average U.S. stock gaining more than 10%. But that hasn't stopped the annual ritual of searching for the most beaten down sectors to play for a dramatic comeback in the new year. It's difficult to buck the market tide, but buying stocks that have suffered extreme declines over a prolonged period can offer spring-loaded gains in years to come. A good example from the past year, coal stocks had lost some 80% over 4 years entering 2016. So far this year, coal stocks as a group have more than doubled. In hunting for such potential comeback plays, contrarian investors can start with sectors down more than 50% from their highs over 2 or more years. One group that now meets these conditions is specialty pharmaceutical stocks. Makers of generic drugs have seen their shares drop by 50 to 80% since early 2015 on a litany of concerns over drug pricing and regulatory threats. Names such as Endo International, Teva Pharmaceuticals, and Mylan now trade at unusually depressed valuations. The pricing and policy outlook remain unclear, but is all that uncertainty already priced into those shares? Looking toward the rest of the world, several countries have seen their equity markets battered. Index funds that track the Italian, Turkish, and Russian markets have all lost between 40 and 60% in recent years. Investors looking to diversify might find cheap entry points in these admittedly troubled economies. Another area deeply out of favor, owners of broadcast stations, such as Tribune, AHBlo, and Gannett, which have shed more than half their value in recent years. Certainly, the economics of TV are being squeezed, but local television hardly seems destined for extinction. One final extreme laggard, how about uranium stocks? An exchange-traded fund that tracks this industry has fallen for 6 straight years by a total of 90%. There's no sense making these hard-hit investments a central part of one's portfolio, and it's critical to do your due diligence. But in a market now trading near an all-time high, these high-risk, high-reward opportunities offer a chance to potentially profit from stocks that are way down but not yet out. For Nightly Business Report, I'm Mike Santoli at the New York Stock Exchange.
Coming up, think Santa's workshop for corporate America. What an Amazon fulfillment center looks like on one of the busiest days of the year. Holiday shoppers spent less money over the Black Friday weekend than last year. According to one estimate, spending totaled on average about $290 per person, slightly less than in 2015. But more people spent online rather than in stores, continuing a trend retailers hope to drive home today on so-called Cyber Monday. Courtney Reagan has more from Amazon's fulfillment center in Robbinsville, New Jersey.
Even though online shoppers can fill their carts any day, the discounts on Cyber Monday have turned it into a top shopping day. The National Retail Federation predicts more than a third of all Americans will shop online at some point today.
This used to be the smallest retail day of the holiday shopping season before we had the internet. Nobody went shopping on the Monday after Black Friday. Now it's one of the biggest shopping days of the season, and so is Thanksgiving. What does that tell you? That's all internet sales. All of the growth this year came on the internet.
Adobe predicts Cyber Monday will again make history as the biggest online sales day ever in the U.S., and Amazon is one of the day's biggest players. While Amazon doesn't release Cyber Monday sales figures, Piper Jaffray analyst Gene Munster thinks Amazon sales will grow twice as fast as traditional online retailers today. Amazon is king of the jungle beyond just Cyber Monday. Analyzing data from 4 million user receipts, Slice Intelligence estimates roughly 2 of every 5 internet purchases comes from Amazon.
This is one of Amazon's more than 70 U.S. fulfillment centers, and it operates nearly around the clock every day of the year. When Amazon looks to the future, it's planning for nothing but growth. It added 18 fulfillment centers in the third quarter, 5 more in early October, on top of the 14 it added last year.
Amazon may make a lot of headlines, but traditional store-based retailers are seeing a higher percentage of sales come from their websites, too. The National Retail Federation says 8 of the top 10 e-commerce players are run by traditional brick-and-mortar retailers.
Certainly a good chunk belongs to Amazon, but we're seeing some better performance from some of the bricks and mortar, traditional bricks and mortar retailers that do have e-commerce businesses. Target, for example, grew its e-commerce sales, its digital channel sales by mid-20% range in the third quarter. Walmart has seen some acceleration in its e-commerce business with the acquisition of Jet.com.
And while traditional retailers are still playing catch-up to Amazon online, around 90% of all retail purchases are still made in stores. For Nightly Business Report, I'm Courtney Reagan in Robbinsville, New Jersey.
Well, there's a lot of work behind the scenes when you buy something either in a store or online. First Data, the world's largest merchant processing network, is one of a handful of companies that makes sure your transaction goes through and safeguards your data. Kayla Tausche reports tonight from First Data's Cyber Command Center in Omaha, Nebraska.
Just how much lighter did shoppers' wallets get over the Thanksgiving weekend? Some companies measure foot traffic down 1%.
It's a little less people this year.
Others, discounts, web traffic, or the most sold-out toys. First Data crunches real spending from the 6 million merchants that use its processing technology or the 4,000 banks whose credit cards are issued by the company. It found sales up 9% for Thanksgiving and Black Friday, and Cyber Monday shopping on pace to grow 10 to 15%. But big spikes could still come from a post-lunchtime procrastination or after the workday ends.
Last year on Cyber Monday, we saw a tremendous amount of activity occur in 2 tranches, one in the 2 to 4 p.m. time frame and the other in the 6 to 10 p.m. time frame. So we're already seeing, as I said earlier, volumes well above last year's level. I can only imagine what we're going to see the rest of the day.
First Data's Cyber Command Center in Omaha makes sure those transactions stay secure even as they move online.
You can see here's our command center.
Andrew Gelb works with banks to keep the billion cards in circulation safe from cyber attacks. He says no threats have emerged this holiday season, but it's early.
We always need to be vigilant.
Experts say late December will still be hectic for retailers and shoppers despite how much buying has already taken place.
Typically what you always have is post-Thanksgiving, December 15th through the 25th is essentially when almost 40% of holiday season sales take place.
For those gift givers, Thanksgiving marks a month-long marathon, not a sprint.
This is the start. We have a big family.
For Nightly Business Report, I'm Kayla Tausche, Omaha, Nebraska.
I haven't started yet.
You're usually way ahead of the game.
Way ahead, and I'm way behind.
You usually say it's October 20th and you're finished. I've done my Christmas
Not this year.
All right, well, we'll play catch up.
Stay tuned. That does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us, and we want to remind you that this is the time of year your public television station seeks your support.
And I'm Tyler Matheson. Thank you for your support. Have a great evening, everybody, and we'll see you back here tomorrow night when all of our shopping will be done.
Absolutely. Every bit.